What's up, real estate enthusiasts? Did you know real estate investors can pay less tax by taking advantage of specific write-offs? In today's video, we will reveal the top 5 tax write-offs that you can use as current or potential real estate investors to keep more of your hard-earned money where it belongs, in your pocket. So like the video and don't forget to subscribe. So let's start by defining what a write-off is. In the context of taxes, a write-off or deduction is an expense that reduces your taxable income, and the lower your taxable income is, the lower your tax bill will be. So by understanding the tax write-offs available to you as a real estate investor, you can optimize your tax savings and improve your profits, from depreciation to home office deductions. So let's talk about write-offs that are sure to make a massive difference in your 2024 tax bill. Unfortunately, real estate investors often grapple with high tax burdens. Real estate is a great investment option for anyone looking to grow long-term and generational wealth or boost their income. What most people don't know though is that real estate is also great when it comes to saving on taxes, which in many cases takes a considerable chunk of your hard-earned money. For this reason, many newbie and semi-seasoned property investors lose their profits in unnecessary tax burdens and end up feeling cheated. So let's first understand how real estate is taxed. Basically, real estate proceeds are either treated as ordinary income or capital gains. If your income is from rent, then the IRS considers it ordinary income and you will pay taxes based on the current income tax rate, which ranges from 10 to 37%. On the other hand, if you sell a piece of property and make a profit from it, this income is considered capital gains. Capital gains can either be short-term or long-term, and each is subjected to a different taxation system. Short-term capital gains, which are the returns you get after selling a house you've owned for less than a year, are treated as ordinary income and therefore subject to as high as a 37% tax, just like rental income. On the other hand, long-term capital gains, which are profits you make from selling property you own for more than a year, are subject to capital gains tax, which can be 0, 15, or 20% depending on the amount. As you can see, the more you make from your real estate investments, the more you'll pay to the IRS. But if you want to keep much more of your returns from your real estate investments, it's important that you familiarize yourself with real estate tax deductions for investors and how to utilize them. Here are 5 tax real estate write-offs to leverage for a lower tax bill, starting with number 1 is your mortgage interest. If you've invested or plan to invest in a piece of property, whether for rent or wealth appreciation, you've likely done so through a mortgage. As long as you have stable income, a good credit score, and some money for a down payment, you don't actually have to save up the full price of a house just to buy it. However, a mortgage, like any other loan, comes at a cost, or if you like, interest. As of July 2024, the average interest on a 30-year fixed mortgage in the US was 7.3%, one of the highest rates in decades. So paying such a high interest rate isn't fun. But however, there is a silver lining to it. You can actually deduct interest paid to the first $7,500,000 of the mortgage from your tax returns for the relevant year. This will directly reduce your taxable income for the year, which then trickles down to a lower tax bill. Keep in mind though, if you have multiple mortgages, for instance, for your primary residence and your investment property, the deductible limit applies to the total loans taken out. Number 2 is depreciation. Now, mortgage interest will definitely reduce your tax burden. However, nothing quite beats depreciation. It is easily one of the best write-offs for all real estate tax deductions you can possibly claim. So how does it work? Strictly speaking, depreciation refers to the decline in value of something because of the day-to-day wear and tear. For instance, a new car loses value the longer you own it. However though, depreciation works a bit differently in real estate investing. It is more about the property's purchase and improvement costs rather than its decline in value. So if you've invested in a house or apartment that you plan to rent out, you can deduct a part of the property's costs throughout the useful life of the property rather than claim the deduction as a one-off write-off. Typically, the IRS allows you to deduct depreciation at a rate of 3.63% for 27 and a half years. Now, to be eligible for these real estate tax deductions, you need to do this. You need to own the property in question, use the property to generate rental income, also show that the property has a useful life that's longer than a year. Keep in mind that you can't claim depreciation deductions for your rental property the moment you buy it. You have to wait until it's available to generate income. This is what the IRS calls putting the property in service. Number 3 is repairs and maintenance. Now, repairs and maintenance are inevitable for rental property investments. That is, if you want to keep your property in good condition and consequently be able to rent it out at a good price. Now, you obviously have regular maintenance and repairs scheduled every once in a while. This includes things like checking if your HVAC is working properly, inspecting the roof and gutters before spring, repainting damaged sidings during the summer, and so on. While these repairs and maintenance are expenses, you can plan and budget for them nonetheless, still eat at your returns. In addition to these, however, there will also be emergency repairs such as a burst pipe, leaking roof, fallen tree branches that damage part of the property, broken down washing machines, just to name a few. These costs can catch you unprepared. The good news is repairs scheduled or otherwise are actually fully deductible in a single year. This means you can claim them at once rather than depreciating them slowly, as is the case with other building costs. Just make sure you keep a record of all your repairs you make for the year so that it's easier to calculate them when it's time to file your taxes. Remember though, improvements and upgrades don't qualify as deductible repairs in the eyes of the IRS. For instance, if an appliance breaks down and you decide to replace it rather than fix it, this will count as an upgrade. Number 4 is property taxes. The majority of states through local tax authorities charge property taxes on real estate. In some cases, this includes personal property like your primary home. Now, how much you pay in these taxes typically depends on the value of your property. So, understandably, the tax bill will look different for everyone. It just depends on how much your property is worth and how many properties you're paying taxes on. But as long as you're paying property taxes, you can actually claim up to $10,000 in itemized tax deductions on your federal income tax returns. Number 5 is home office expenses. If you're a real estate investor who uses part of your home for business purposes, you can actually deduct related expenses from your taxable income. Yes, you heard it right. You don't need to have an office on separate premises to incur office expenses and consequently claim deductions. The best thing about home office deductions is that it's not just one expense you can claim. You can deduct utilities such as electricity and internet, insurance, supplies, repairs, office furniture, office computers, and the list goes on and on. But there's a catch. Your home office actually has to qualify as one. As per the IRS, a home office is a space used exclusively for business purposes on a regular basis. In short, you have to use the space exclusively for real estate business. All in all, if you decide to invest in real estate, you have to accept that you will pay taxes on income or capital gains made. There's no escaping this. However, you can significantly reduce your tax bill by leveraging the power of deductions. There are numerous deductions you can write off on your tax returns. However, mortgage interest, depreciation, repairs and maintenance costs, property taxes, and home office expenses are without a doubt the best write-offs to maximize your real estate tax savings. By understanding how to utilize each deduction, you will definitely see a lower tax bill this year.